You've been learning breaker structure wrong this entire time. Your favorite SMC trader probably tells you a breaker structure is a strong impulsive push above an old swing high or below a swing low. And you get in this scenario where you have this strong impulsive move lower, you have this bearish fair value gap or this bearish supply zone. So then you probably take a short here anticipating price action to come lower below here, and then this is exactly what happens. You get stopped out every single time, and that's because you're learning breaker structure wrong. And in this video we're going to cover exactly what you need to know on how to master breaker structure and actually learn market structure the right way. Before we get into the video, make sure you guys are following me on Instagram if you guys have not already. This is where you can find me, as well as I'm constantly uploading value and giving free education to the community through my Instagram, as well as I'm always checking my DMs and replying to subscribers and followers messages that you guys do send me. All right, back to the video. We have to understand who exactly pushes the market, and this is classified as smart money. And smart money can be identified as the algorithms, large banks, institutions, hedge funds. These are large players in the game that have massive amounts of capital. So when they enter the markets, they enter under heavy size, which can give you impulsive moves like so. Right, and this is called smart money footprints, right? Large moves like this is our indication that smart money is entering the marketplace, because you, me, and your friend Jimmy down the road, we cannot move the markets, right? Retail traders is not pushing the markets this heavy higher. This is our indication that smart money has now positioned themselves inside of the markets and are positioning themselves under heavy size, meaning we want to catch the tail end of that move. But you have to understand, not every single strong push higher or strong push lower is classified as a breaker structure. And this is why in this depiction, you see our trader here classifies this as a breaker structure. He thinks the market has broken lower and is going to pull back to then see a continuation lower, only to get stopped out. And this is where we get into our first lesson, right? Before any single breaker structure, you have to understand there has to be a narrative behind it. And what is narrative exactly? Narrative is what is the market seeking at the moment. And if we know anything about the marketplace, it seeks one or two things. The market seeks these two things: liquidity and inefficiency. If we look at this depiction here, if we want to see the market offer a breaker structure and change the overall trajectory of the marketplace, it has to come down into either a liquidity pool or an inefficient level to then reprice before then breaking higher and changing the overall trend of the marketplace. If the marketplace is just going lower and you don't understand the two tendencies of the marketplace of liquidity and inefficiency that it is sinking, then you will see this as a breaker structure, right? Market comes back up here. You think this is a rejection zone and the market should collapse lower, but you fail to understand that as the market came lower, it tapped into a liquidity pool, gathered liquidity, and this inefficient level that you think the market is going to find rejection at and push lower will then be broken and inverted to then push the market higher. And if you understood that price action took liquidity down here, and after taking liquidity it pushed higher, right, you would understand not to take this trade and instead anticipate the longs for that continuation move higher. And that is exactly what happened in this depiction here, right? So as we can see here, we seen this strong move lower at 8 a.m., right? So a lot of retail traders anticipate this as some type of break of structure, right? Strong move lower, smart money is entering the marketplace, this is gonna go lower, failing to understand that on the H1 here, we have a H1 order block, right? We have a H1 order block that price has come down, tapped down into, and after tapping into that H1 order block, we get this strong move higher, right? This right here is the real break of structure. Let's classify this as a BOS. This is the real break of structure. This isn't the real break of structure. This was simply the impulse leg to then get into this higher time frame inefficiency to then deliver the real move in the marketplace. And that's why our first lesson, narrative, is so important. You have to have narrative behind it. Not every single strong move higher or every single strong move lower will be classified as a break of structure. There has to be a reasoning behind it. So here's something that could possibly happen to you guys, and probably has happened to you guys in the past. So as we can see here, we get this strong move higher, right? You probably see this fair value gap or this last down close candle here as an area of support, right? This last down close candle as an area of support to then see the market push higher, right? That's probably what you see. But you fail to understand that the market has been trending lower, and prior to price action coming into the London session, we've already gotten a break of structure lower, pullback. Price action came up higher to take out these London session highs before then offering the real break of structure, right? Before then offering the real break of structure to then take the short down into these lows, right? This is the real move, right? If you would have taken the longs here thinking this was the break of structure, then you definitely would have gone stopped out because you're not aware of the overall narrative of the marketplace. The marketplace has been making lower and lower prices, right? This push higher was simply a push higher to then take out this Asian session liquidity. It came up, take out this Asian session liquidity, and then we saw that break lower, which we can capitalize on to then take out these prior daily lows. This is why narrative is so important. You cannot just take every single strong impulsive move higher or every single strong impulsive move lower. There has to be a reasoning behind it. Has price action recently taken out liquidity? Has it recently tapped into a support or resistance level, right? Support or resistance and efficiency. And what is the current trend of the marketplace, right? So boom here, right? We get into the London session ending here, right? As London session is about to finish, we just recently taken out these prior daily lows. Let me mark them out here. We just recently took out these prior daily lows, and then we get this break higher, right? What is the narrative here, right? We've been making lower prices, then we came lower and then swept liquidity. We came lower, swept the prior day liquidity, and after sweeping prior day liquidity, we then get a break higher, right? You have to understand the marketplace seeks from liquidity pool to liquidity pool, right? The marketplace comes lower, takes out this liquidity pool, breaks higher to then take out the opposing liquidity pool. Same thing with inefficiencies. The market will go higher to then tap into an inefficiency, break lower to then come down into an opposing inefficiency, right? That's why the market seeks one or two things: liquidity and inefficiency. It bounces from liquidity to inefficiency, liquidity to inefficiency. So in this depiction here, we see price action come lower, take out this prior daily liquidity. Okay, we just took out liquidity. Where are we targeting next? We're targeting the opposing liquidity pool. If we just took out this sell side liquidity pool, our next area of targeting is a buy side liquidity pool. What is the most recent buy side liquidity pools, right? We can mark out these highs here, right? You could mark out these highs, and coming up here, this London session high, right? These highs up here, and eventually this London session high. So these are the liquidity pools that the market will most likely seek next, because as you understand, the market seeks liquidity pool to liquidity pool and efficiency to inefficiency. So as we came lower to then take out these prior daily lows, we then see this break higher, classified as a break of structure. This is the real break of structure because there's narrative behind it. We've just taken out liquidity, right? Compared to this break of structure, there was no narrative behind it. This simply was just a move higher, right? This simply was just a move higher to then take out these highs to then push lower. So if you thought this was the break of structure and tried to go long, you would have lost. And a lot of traders end up in this situation, right? And this is called inducement, where the smart money and the big players, they'll purposely push the market higher to get retail traders riled up to think this is a break of structure. The market's going higher and higher and higher, but all smart money is doing is pushing the markets higher to then capitalize on these traders' stop losses, take them out before then dropping lower. So not only do they capitalize on the traders that chase this move higher, but they also capitalize on these traders here that put their stop loss above this high. So this is called inducement, and a lot of retail traders and a lot of SMC traders get faked out by this. But after this video, I hope you guys understand breaker structure enough to a point to where this no longer happens to you. So what we can see down here is these last down close candles identified as an order block, right? This last down close candles, order block, demand zone, whatever you want to call it. As price action comes down here, we can be confident putting our limit order here, stop loss below the low, targeting old highs, right? We can target this high right here, and we can eventually reach up into these highs right here for a 5-to-1 R, right? And we got this trade based off of narrative. Price action came lower, swept these prior daily lows. After sweeping these lows, we see a break of structure, right? We swept lows, price breaks higher. This is our indication of smart money footprints. So if price action came lower, swept these lows, smart money entered the marketplace to then take the market higher, we want to anticipate some type of pullback into a support level to then see that continuation higher with smart money. Next, we can get into gold here, XAU USD. So as you can see here, coming into the Asia session, we see price action coming higher up into these Asian session highs, take out this liquidity pool, followed by a strong break lower. So we can anticipate this to then be our area price will retrace into, stop loss above these highs, targeting old lows or old bullish inefficiencies, right? So this would be a valid trade idea, right? Because there's a narrative behind it. We came higher to take out the liquidity pool, followed by taking out that liquidity pool, we see this break lower. Then based off of the break lower, we want to identify any inefficient levels in price action to where we can then anticipate a pullback, right? So we identified this bearish fair value gap. We anticipate this pullback to then see the market target the opposing liquidity pool, right? Or opposing inefficiency. So you could also target this last down close candle as well. So you could put a limit order at this last down close candle or below the old lows, right? The market seeks liquidity pool to liquidity pool, inefficiency to inefficiency, right? So that was the overall narrative for that trade. So boom here, right? We came lower, we swept Asia lows. Boom, we swept Asia lows, bang, boom. And then we start to consolidate, and then we see this push higher. We see this push higher, right? What did I tell you guys in the previous example? The market seeks liquidity pool to liquidity pool, inefficiency to inefficiency. If we came lower to then sweep out these Asia lows, then after sweeping out these Asia lows, we see this push higher here. Guess where the market is going to target? The opposing liquidity pool or the opposing inefficiency. So we came lower, swept these Asia lows, then we get this break higher here. Now we're anticipating a pullback once again to then target the opposing liquidity pool, right? This high and even up into these Asia highs. So these can be opposing liquidity pools, right? After the market swept these Asia lows, to then the market then targets next. So how to identify the best opportunities and the best inefficiencies within a pullback is through our dealing range. Actually, let me use a Fibonacci. From low to high, you want to have the 50%, right? Anything below the 50% level, right, is a good inefficiency, right? So what do we see here? we see this order block, right? This last down close candle. Inside of this quote unquote discount, right? So the high is a premium. You want to go short in premiums and buy in discounts. Like in this depiction right here, from high to low, above 50% is a premium. So we want to go short in this premium. And what do we see? Above 50%, we had this bearish fair value gap. Price action came back up into this bearish fair value gap to then give us the opportunity to then go short. And in this depiction, right, we came lower, swept these Asia lows, seen this break higher. We marked out the high to low, right, and below the 50% level in this discount, we have this bullish order block. So now we're anticipating price action to come down into this bullish order block, stop loss somewhere down here, to then target opposing liquidity pools. Our first take profit could be up here and eventually up here. So boom, this is what we are seeing now. Price action comes down, taps us in. Let me get rid of this red box. As you can see, taps us in. And then we eventually reach up into both take profits, right? And that's based off of narrative, right? Price action came lower, swept these Asia highs, right? Then we saw this break lower. We went high to low, above 50%. We got this bearish fair value gap, went short, bang, targeting these Asia lows. Then after taking out those Asia lows, price accumulated back and forth before then seeing a break higher. Boom, right? We just took out these Asia lows followed by a break higher. Smart money is now entered into the marketplace, right? When smart money buys, they add to their positions, right? So if smart money is going to buy down here, right? If smart money is buying below these old lows, what makes you think on a pullback they're not gonna buy more, right? So as smart money buys below these lows and they move the markets higher, as the market then pulls back, they buy even more to then continue the market higher. So as we can see here, price sweeps these lows, then smart money pushes the market higher, and as the market comes back lower, we can now get into the markets as smart money is adding to their winning positions to then catch this nasty trade here in the opposing liquidity pool, right? So it's all about having narrative behind your trades. It's not just about a break higher or a break lower. It's a break higher or a break lower after price has either tapped into a inefficiency or tapped into a liquidity pool, and then followed by a breaker structure targeting that opposing inefficiency or liquidity pool. In our last depiction here, we have the Dow Jones. So you probably see this break higher, right? So you're thinking this is a breaker structure, right? Price action, so pull back to then continue making higher prices, right? So then you probably aim for lows to highs. You identify your discounts, right? You get this bullish fair value gap here. So then you probably put a limit order here, stop loss, just down here, targeting, maybe these highs here. And then exactly this is what happens to you. You get stopped out, right? Exactly. And you overall lose on this trade, right? Because you're not aware of the overall narrative. I would not go long here because of the fact that on the H1 time frame, price action has just came up into a bearish order block. Price action just came up into a bearish order block, right? Following coming up into that bearish order block, we then see this rejection lower, just like so. We then see this rejection lower, following tapping into that resistance level. I would not take a long here after price action has tapped into a higher time frame resistance, following by a breaker structure. Same thing with a bullish, right? I would not take a short, right, if the market taps into a bullish area of support followed by a breaker structure, right? You don't want to do that, right? So in this depiction, you putting the fair value gap here, thinking that it's gonna hold, not being aware that it just tapped into a higher time frame resistance level, most of the time you're gonna lose on this trade, and you're gonna continue losing on this trade until you understand why narrative is so important. So as price action came up into this bearish resistance level, then we get this strong push lower. I'm anticipating the pullback now, the real pullback, right? High to low. I'm anticipating the real pullback to then take the market lower into these lows, or this last down close candle, right? We can have our first take profit at this inefficiency level and our final take profit below this low. After tapping into that resistance level, we're seeing strong movements lower, right? Smart money has now entered the marketplace, and most likely they're trying to push the markets lower, right? So if I understand smart money has not shorted at this H1 order block level, why would I then go long opposing smart money when they're the ones that control the markets, when they're the ones that's actually moving the markets? I cannot move the market, so why would I ever try and go against them? So as we see the market moves lower and breaks lower, we can classify this as the real breaker structure, and then anything above here in a premium, that's where we will then go short. So what do we see here? This last up close candle inside of this premium level, we could go short here, stop loss above this high, targeting this last down close candle here, and eventually down into these lows. And look at that, we got a 4 to 1 R, just like so, right? Because we understood narrative and we did not just take along based off of the market just pushing higher. We understand the market was just pushing higher to then tap into that bearish order block level to then give the real move, and then we were able to capitalize off of the pullback. And that's why it's important to understand narrative when it comes to breaker structure, and not just take any long or short following a impulsive leg higher or lower. So that's going to be it for the video. If you guys are looking for more in-depth content and mentorship, I have released my private mentorship called the Traders Asylum in my Patreon, where you get access to my private mentorship, beginner and advanced lessons that's not shared here on YouTube or anywhere else, daily pre-market, live trading, post-market analysis, plus trade breakdowns every single day, direct access to me, video requests, analysis requests, and any questions you guys have, live trading for the S&P 500, NASDAQ, and Dow Jones every single morning at 9:30, as well as psychology lessons, my full risk management plan, and trade management plan, as well as you guys do have access to a private community for all Asylum members, right? Right now, I do have a early access membership going on for this month, where you get access for only $10 a month. In the future, the price will go up to maybe, $20, maybe even $30 a month. If you guys are watching this in the future, the prices have probably already went up. So, but if you guys are watching right now or throughout the next 2 weeks, then my mentorship is still $10 a month. So I am offering that if you guys are looking for more in-depth analysis or a mentor to really help you guys kickstart your trading and really cross that threshold of profitability. I hope you guys like this video. I'm Arkham. Be safe.